Welcome everybody to day 2, session 2 of the Pairs Trading Mentorship. As you know, yesterday what we went over was kind of like the basics of what pairs trading is and setting up your screens, looking at what the spread ratio is, the spread difference, looking at correlations, talking about what the two different legs of a pair are, when you go long, when you go short, all that good stuff, what being long a pair means, what being short a pair means. One thing I forgot, I kept thinking I was forgetting something yesterday, and I knew I did, and this is what it is. When you're looking to trade pairs, all right, you always want to make sure you have enough time for the pair to move your direction, okay? You know how yesterday I said it's not like breakout trading where you have an exact, we get in and then boom, it should start moving our direction. Pairs trading is more like we're getting in at an area of an extreme, where the market's trading at an extreme, and then we're looking for it to pull back to normal, right? But it doesn't have to happen right away. So one thing you want to make sure you do is you know when the rollover is going to occur, okay? So you need to make sure you have enough time for your pairs to actually play out so that you don't get stuck in a trade and then the contract month rolls over and then there's no volume and that pair just kind of, you're stuck being in a losing position, okay? Normally I want about a month at least, or at least a couple of weeks, I should say, before that contract is going to expire if I'm going to place a pair in it, okay, if I'm going to place a trade in that. That way it gives it enough time, that way I have enough time and know I have at least a couple of weeks for that market to move and for it to start moving back my direction. The probabilities of it just sitting still for the next 2 weeks are very low. Okay. Now, I think I sent this out with yesterday's email. Did I? The rollover dates? Anybody tell me? No? Okay, I'll send it out with the one today then. All right, this is, sorry about that. This is rollover dates for different futures contracts. So I know I said you can be trading pairs in equities and options and ETFs as well, but for futures specifically, because that's what I trade mainly, I put together this thing that's just showing when it rolls over. Okay, now all you got to do in order to look at it or in order to tell when the rollover is, so for example, the Australian dollar, the symbol for TradeStation anyway, it rolls the 7th of the rollover month. So if the June contract, if we're trading a June contract, it rolls over June 7th. Okay? For example, we go down, we look at the Russell or the S&P 500 ES, all right, that rolls over the 7th, the month of the contract. Okay, so June 7th of next month, a little bit less than a month from now. So that'll roll over. Go look at something like gold 24th, 1 month before. So if we're trading June contract, so May 24th is when you're going to roll to August. Okay, so in 14 days or 15 days. Does that make sense to everybody? You guys see how to read that? Good deal. Alrighty, so I'll send that out tonight when I send out the recording. So today we're going to be talking about when we want to enter trades, right? And today we're going to talk about entering trades. Tomorrow we're going to be talking about entering trades. We're going to talk about 2 different ways of doing it. First, let me pull up a different pair here. Let's look at ESM17. And we'll look at YMM17. Use this for an example because this is a pair that I'm in right now. Alrighty, so what we're looking at here is the S&P, which is green, versus the Dow, which is orange. I want to walk you through kind of what I look at when I'm looking to place a pairs trade. All right. First thing I do, and this seems really simple, is you're just going to look at your chart, and you know how we talked about the location of the two markets. So if we're plotting both these markets, we show from the start of when these contracts started trading, or as much information as we can. They both started around the same price, and S&P so far has moved up higher further than the Dow has, right? So the Dow is lagging behind the S&P a little bit. Normally they trade on par, okay? So if that's the case, and I'll look at them and I'll say, all right, well, the spread here, we're getting kind of spread apart. So that means there's something going on that's causing them to not be moving together. So I'll say, all right, let's see if there's a potential opportunity. Now, what we're going to talk about today is kind of a reversal. It's a counter trend, so to speak, or it's mean reversion. So we're looking for these to have gotten out of whack and pull back together. So let me take a screenshot here so I can start drawing on it. So when we're looking at this, all right, and we see that they are spread apart, there's something going on that's causing them to not be moving together. And again, normally I'm doing all this on a 60-minute price chart, 99% of the time. Then I'm going to go and I'm going to drill down and I'm going to look at my spread difference and my spread ratio. And what we want to see in this case, if we're doing a mean reversion like what we are here, we want to see the spread difference and the spread ratio nearing a support or resistance level. So in this case, we go back here and we look at, that's the previous resistance. There you go. So we're right up against that resistance. Make sense? Last time it got up there, we hit it, pulled back. The other time we broke through it just a hair and then came way back down. All right, so we know that that's an extreme that it normally trades at. We can also look at the support extremes. Where are the extremes at that we normally trade at on support? Well, right there is a support level. We've hit it here and bounced off of it. We hit it here and bounced off of it. We hit it here and bounced off of it. So we know, okay, if it comes down there, we can be looking for going long the pair, and then we can say the ultimate extreme is going to be anything down below this line, which we've hit it a couple times here, here, and then the lowest low is all the way down there. All right? And what we're essentially looking for it to do is we look at what's the extreme that this pair has traded at previously, what's the ratio extreme that we've traded at previously, and are we getting near those extremes? Okay? Makes sense? So in this case, I'm short this pair right now, so I'm short the S&P and long the Dow. It's down a little bit at the moment. However, I'm short because we are against this extreme. We've hit it a couple of times back there. We've hit it over here. Every time we've hit that, or just about every time we've hit it, we've retraced back from it. So we're looking for this to turn around and come back down, and the first support we'll look at is going to be right down here, then down here, and then down here, and then down here. All right? Now, just like when we read a price chart, you hear me talk all the time about higher highs, higher lows, and lower highs, lower lows, right? And talking about the trend and how what we're looking at are pivot points. And for those of you that don't know, support on a price chart is where you've pivoted off of it. Usually you want to see it have pivoted off of it at least 2 times. Okay, resistance will be the exact opposite. It has to have hit it at least 2 times the upside. All right, so when we are looking at this, we're going to look at both our ratio and our difference, and we want to see, for example, in this case, our difference is trading inside of a channel here, all right, and our ratio is essentially trading inside of this zone here. Okay, we are at the upper end of the ratio channel. We're just about at the upper end of the difference channel. We're nearing resistance in both of those indicators at the same time. Everybody following along? Make sense? So when we start getting into one of these support or resistance zones, then we trade the opposite direction, look for it to bounce off of it. Okay? And that's what we're looking for in this case. We want to see this bounce off that resistance, turn around, and start to move lower. So either what we want to see happen is either the S&P drop faster than the Dow drops, or the Dow rally faster than the S&P rallies, or best case scenario, the S&P drop and the Dow rally. And that'll move both of these down. All right? Makes sense? And again, all you have to do is we're looking at kind of a support resistance zone. Now, because it's a pair and you're not timing the trade to the tick, this is now when we get in, this is now when we get out type of thing. It's a zone. So we're getting in this pair because we are nearing the extreme here. But you can see even back here, if you had traded this would not have been a bad pairs trade. Selling it right there. Now it continued to climb a little bit more and it started to fade back down. Okay. Now, when you're trading this, you have to be careful. And the reason I say you have to be careful is because although, yes, we're getting into a zone, you still need to have that uncle point, that time where you're saying, all right, it's gone too far, it's time to get out. It's okay to pull the plug. Unless you are somebody that has a much larger account and you don't mind having a couple $1,000 risk or potential loss waiting for it to come back your direction. Okay, and the reason I say that is because let's go look at something like gold versus silver. And this is a pairs trade that I placed, and this is one I lost a little money on. But I mean, the grand scheme of things doesn't really affect the equity curve that much. But what I was looking at here was I was at an extreme and I was selling it at the extreme. Actually, I think I was going off of this high. I think it was here. And I was selling it right here at the extreme. Okay, that's would normally be a good trade. However, this started to trend and continue to trend and trend and trend. And silver continued to become more devalued compared to gold. Okay, gold became more expensive compared to silver. So what happened is if I had held on to that, and I got out with like a $150 a pair loss or something, but if I had held on to that, you're talking several $1,000s in the negative. So the reason I say this is you need to have that uncle point of, all right, it's moved too far. It's looking like it's trending. Okay, now that's if you're trading a smaller account. If you have a larger account, if you have a bigger account size and you don't mind allowing a trade to have time to play out and you still think it's a good trade, what you do is when you get to an extreme, if it continues to push through it, because you are already entering at an extreme, if you're negative, that means it's already even more, it's gone even more into an extreme, it's out of line with how it normally is trading. You can add to your position, okay, and bring your average entry a little bit higher. Now, I'm not sitting here preaching martingale strategy or anything like that, or I don't ever tell people to add to losing positions except for in pairs trading, and only if you have a larger account and you don't mind the fluctuations. That being said, you still need to have an uncle point at some point in time. You need to know when to call it quits. Okay? So normally, for me, it's either going to be, it goes several $100s per pair against me, or it takes more than a day or two to start moving back my direction. Because if we're timing it off a 60-minute price chart, it should be turning within a couple of days at the most. And then you can, for example, I think my longest trade I've had trading off a 60-minute pair was like 5 or 6 days. All right, so keep that in mind. It should be moving in your direction within a couple of days. And if it's not, you can always just close the pair and look for another setup. All right. Now, another example of this, and what I mean by how larger accounts, how you would manage it with larger accounts. Here's another trade. This was RBM RBOB versus heating oil. And this was because what I'm doing is I'm trying to grow a smaller account and show it to be able to show you guys how you do that, how you manage that. This is a trade that I ended up taking a loss on that normally I wouldn't have taken a loss on. Because what happened here is we got way out of line. All right. RBOB was really undervalued compared to heating oil. Okay. So I was long RBOB and short heating oil, and I was doing it on top of this pivot right here because that was an extreme, and I was getting in it in the trade right there. Okay. Now, again, normally I would have held it because that was an extreme and we were still looking for it to bounce back. I would have added as we continue to sell off. However, in this case, I closed the pair right down here because it continued to move and took a bit of a loss on it. I think this was like a $250 loss or $300 loss, something like that. It's the biggest one I've had on this account. But normally what you would do is, okay, so it gets back into another extreme and it starts coming back up, so you add to the trade. And then that means your average entry would be down here, and as it climbs back up, you'd go break even, so to speak, so you wouldn't allow it to go negative anymore. But you would add to it as it gets even more extremely undervalued, and you catch that ride back, and then instead of having a losing trade, you have a trade that makes several $1,000s. Does that make sense to everybody? So that's the difference between trading smaller account versus larger account. Smaller account, pull the plug, live trade another day, just take that small loss. One thing that a lot of traders get afraid of is taking a loss, and you cannot be afraid of having a loss. Losing trades are going to happen. All right? Taking a loss is allowing you to survive to trade another day, because if you don't take a loss and you have a huge unrealized loss, some point you're going to have to cover it. All right? And then you just blow up your account in one go. If you take a small loss, then you have plenty of ammunition, plenty of ammo to keep trading. Emmanuel, you asked, which one do we go long on? If you go watch the video, the recording from yesterday, we talk about knowing when to go, when you're going long a pair or when you're going short a pair. So if we're looking for the spread ratio, so in this case, we're looking for the spread ratio to go higher, right? So we're going long the pair. If you remember from yesterday, if we have two contracts, right? We have RBOB, RB, contract number 1, and then we have heating oil, contract number 2. All right, so if we're going long the pair, that means we're going long RBOB and we're going short heating oil. If we're going short the pair, that means we would be going short RBOB and long heating oil. Remember, if you're going long, the first one on the pair is when you're going long on. If you're going short the pair, the first one on the pair is when you're going short on. Make sense? Now, another pairs trade I had previously, you can also, so you're saying, can you trade a breakout of support or resistance? You can, but they don't always work. Again, you're kind of looking at two different trains of thought, because this is mean reversion. We're not really trading the breakouts. You can be looking to trade breakouts, but those trades are not going to happen as often as mean reversion trades are. So he's asking, can we trade, for example, instead of going long here, we go short the pair because it's breaking the support, and you catch this little run down here? Yes, you could, but normally what's going to end up happening is it's going to get to an extreme and come back up. So, for example, where you run into problems with that is normally you would be looking at this and we'd say, okay, this is at an extreme, so we're looking to sell here, sell here, sell here, sell here, sell here, all right? And if you're going long because it pokes through it, the majority of the time it's not going to run your direction. It's going to move back to the normal. So, for example, if you took the low here and you said, okay, I'm going to sell it here instead of buying it, it barely moved down, but the reversion the retracement back to the normal is about 3 times the size. We're looking for that bigger move, not the smaller move. Do we enter as soon as it touches the support or resistance, or is there time to wait to enter? It's a good question. So you have 2 different options on entering. You can either do what I did, for example, right now with the S&P Dow, where I'm selling it because we're getting there, so we're running into it right now. Or your second option, which is a safer option, you'll get a little worse fill. However, what you do is you wait for this to roll over, and as it starts coming back down, then you jump on board and kind of catch the rest of the move down. Okay? So if you want to play a little safer, you wait until it actually starts rolling your direction, then you jump into the pair instead of hitting it, or instead of jumping in as it's hitting the extreme. Can we just buy the one below and short the one above on the chart, whether we are long or short? That's how it should look anyway. I mean, it'll show up the same way, Tarife. So yes, but that's not how you want to time your entries. Can you put a moving average line on the spread ratio? There's not a way to do that on TradeStation. But that's actually one of the things I'm thinking about doing, is putting together an indicator that plots a moving average so you can see when it hits an extreme, so you can catch that bounce back. I'm thinking about doing that in the future. Right now, the TradeStation's default indicator doesn't have that. Okay? Any questions? Any more questions about entering at the extremes? Do you ever look at longer-term charts that can establish a mean? It's either seasonal or moves to intense rate policy changes. Yes. So that's a really good question, Robert. So if you look at a 60-minute price chart, okay, your extremes are going to be different than if you look at a daily price chart. And one of the ways you can time when the really good pairs are going to happen is, so we take a look at the 60-minute. Let's go. This is RBOB. So this is RBOB heat and oil pair. Okay, we're getting back down near that extreme, down near the lows once more, because we had a report this afternoon. RBOB shot lower, heat and oil went higher. But if we go look at a daily, okay, that extreme is not quite there yet. If we look at the daily, we can see that over time, this could actually come back down a bit more to about even, 1-to-1 spread ratio. Okay? Now, if you get an extreme where this is all the way down on our dailies, plus our 60-minute is all the way down top of support, then that's a much better pair. It's a much better support or resistance level. So you can apply multiple time frames to this. Absolutely. You have a radar screen to look into these pairs? No, I do not. You just go through and you change your chart. You can set up different workspaces if you want. I normally just type in whatever pair I feel like looking at. And again, because we're not trading breakouts or things like we normally are in the trading room, we don't have to be exactly on time, so to speak, to enter the pair. It's all right if it takes a little bit longer. Now, another thing, if you have strong reason for directional bias, all right, you know how yesterday we talked about notional value and weighting your pairs, or weighting each leg of the pair according to the notional value? Well, if we have reason to expect a market to fall through the floor, so let's say, for example, for some reason, we expected gold, or we expected RBOB and heat and oil to push lower overall. We expected the energies to have a down move here, but we wanted to still trade the pair. You can off weight, so you can add additional weight to the downside. So instead of doing a 1-to-1 ratio where you'd be long RBOB and short heat and oil, you would go short 2 times heat and oil, long RBOB times 1. Or you could do 3 times heat and oil, 2 times RBOB. So it's just slightly more weighted in one direction or the other. No, you don't do the opposite. You just weight whichever directional bias you're taking the neutrality out of it. Instead of being a market neutral position because you're equally weighted based on notional value, you're now directionally biased based on how many contracts you have and your outlook. A time I did that, I did it back here. I didn't do it in RBM. I did it in RBK, RBOB versus, actually I think it was crude oil versus heating oil, one of the two. And it was on this breakdown here, I believe is where it was. And I'll show you. I have the picture of it. We'll go over it on Thursday. But I weighted a couple extra contracts short. So if my pair, if I was trading, instead of trading 5 contracts and 5 contracts for RBOB heating oil, it was like trading 8 heating oil short and 5 RBOB long. Okay. So we were expecting it to push lower because of the breakout. So I gave my pair a bias towards the short side. Now keep in mind, if you are doing that, you are no longer trading market neutral pairs. So direction matters. So if you're wrong on direction, then you can cause some some damage there. And I don't normally say that that's a good thing to do. All right, keep that in mind as well. Normally, I'm looking to stay neutral. Over the past 4 months, or actually 5 months since this year started, I think I've done that 2 times. And they were both in the energies going short. So it's essentially just hedging your directional trade. Exactly, Bill. You got it. So you're adding a hedge in case you're wrong. You're not going to lose as much money, but you're still placing a short trade, or you could do a long trade as well. Can you use a stop loss if you're directionally based? Yeah, you could be using a stop loss if you're directionally based. Okay. If you look at the chart, what's the first thing you look at? If it looks good, the second, the third, etc. before you look into a trade. First thing I look at on the right-hand side of the chart is what do these two markets look like compared to how they've been moving recently. So in this case, I look at this and I say, okay, heating oil's trading way up here, RBOB's trading way down here. So the spread just widened. All right, it just widened because we had an announcement this afternoon and RBOB dropped lower, heating oil stayed high. Okay. So that's the first thing I look at is there a spread here? And if they're trading around top of each other, for example, what's a pair that's trading around top of each other? Well, RBOB heating oil here, crude oil versus heating oil. So if I pull up CLM, crude versus heating oil, you can see they're basically around top of each other. There's no spread on the chart. You see that? I don't want to mess with it. I want there to be an obvious difference between the two contracts and the way they've been moving recently. Once I see that, then I go, okay, let's look about potentially placing a trade. Make sense? So first thing is that, then I'm going to go down and look at my difference in my ratio. Are we near support or resistance? Yes, no. Is it near support or resistance on both? Has the market been trending? Has the ratio been trending one way or the other? So are we in a consolidation mode or a trending mode? All the above. And then I decide to place a trade. Make sense? Yeah, the obvious, it'll take a couple hours, it'll take at least several hours to potentially a couple of days for it to get to a point where you're going, oh, look at the extreme. So for example, RBOB heating oil right now, this is at a pretty good extreme. By the way, you know how I talked about earlier, you don't want to be trading the contract right before it rolls. I believe these are getting ready to roll next Tuesday, I think. So you wouldn't want to be trading this because there's less than a week's worth of trading to make up. So instead of trading RBM, we would roll over and trade the July contract. And we go, all right, so if this contract looks like this, let's see RBN17 and see what heating oil looks like in the July contract. Okay, spread ratio, spread difference is still pretty good. I'd like to see it come down a little bit more towards the extreme here. And then you go, all right, so this still looks good. We're getting close to the extreme. It's not quite time to place a trade. I mean, it could still come down a bit more, another couple $100 per pair. And then we go look at the daily and say, all right, well, what's the daily looking like? Okay, well, the daily's not really at an extreme on either one. Daily's saying we could go down quite a bit more. Actually, you know what? Maybe. Yeah, we are actually on a turning point here on daily. So it could be, this actually could be a potentially decent trade. I still would want to time it with the 60 a little bit more. So I want to see it come down a little bit more. And then look to get in. And then you look to ride it back up. But we wouldn't want to trade June contract. We want to trade July so that we have, then we say, all right, we have over a month for this to move back our direction. So we give it plenty of time for it to play out because it could take quite a while. It could take a week or two for them to move back together. Now, the other thing you do want to be aware of, and this is especially true for what's happening right now in RBOB versus heating oil. This is event-driven, okay? They just had the announcement. I don't know what the actual numbers were without having to go look them up. But when it acts like this after the announcement, normally what caused this is that there was a shortage or supply was not as high as, or demand was not, or was higher than expected in heating oil, and it was much lower than expected in RBOB. So there's an excess in inventories in RBOB. So that's what's causing RBOB prices to go lower. If that's news driven, this could continue to push lower for quite a bit more. That's what caused this last breakdown we had back here. It's because it was news driven. So be aware of that. So you say related to Robert's question. All right, before I answer that, so just to recap, make sure you're not going counter to some fundamental reason that's causing your pair to get out of whack. Especially true if you're trading something like the BUB spread, which is 30-year bond versus ultra bond. Okay, if the Fed is in there pushing prices around because they're making changes to the interest rates, that's going to affect that spread quite a bit. So be aware of that. All right. So don't go against fundamental reasons. What am I looking for here? Here we go. Now you said, related to Robert's question, you initially didn't take the S&P Dow trade this morning. What made you get into it this afternoon? So this morning, S&P Dow was trading right here on our spread ratio. I waited until we got up near the highs here, and then I placed the pair. That's it. Okay. For this pair, for example, margin, if they do not offer, well, margin varies greatly by broker, so it's really kind of an impossible question to answer. I mean, they really vary by broker. Some brokers you'll have $1,000 or $2,000 margin. Other brokers you'll have a $7,000 or $8,000 margin. In TradeStation, this is around $8,000 per pair. Maintenance, or a little less than $9,000, $8,750 per pair. Does the Petroleum Status Report create pairs trading opportunities? Yes, it does sometimes, but again, don't get caught if crude oil, for example, has much lower demand and then RBOB has much higher demand. That's going to push those prices in opposite directions. So don't get caught jumping in there right as that happens. Let it settle down a little bit and start to move back together, then jump in. Anyone in the room use TOS? I have studies that look like yours, but the price chart has big gaps between two prices. There's something that I'm missing. Are you looking at continuous contracts, or are you looking at each front month? A lot of people use TOS. I'll send out, did I not send out the document that explains how to set it up in TOS? All right, I'll send that out tonight as well. Okay. Any other questions? Yeah, don't use continuous, Kathy. Do not use the continuous contracts. That's one of your problems. So when I send the recording out, I'll attach, let me make a note here. I'll attach both the rollover dates and TOS instructions. Nope, I do not have a way to do that, Manuel. Sorry. Alrighty. Any other questions? There are a list of favorite pairs that you look at regularly. Yeah, they're in that document I sent out yesterday. I know I sent this one out yesterday. I attached this right here. Here's some of my favorite pairs. Let's say I know I sent that one out. Okay. Any other questions? It should have said, give me a minute. I sent it last night after the Pairs Trading Mentorship Day 1 recording. Today's will say Pairs Trading Mentorship Day 2 recording. Lee, I do not know. Just send out the notional value calculator. Yep, that's in that Excel sheet. Remember that notional value calculator, all you do, you change, so here's just some of the markets. I mean, you can add the other ones. You change the price, the current price that it's trading at. That'll tell you the notional value. Put the notional value of the two contracts in here. Tells you your ratio, and then it'll convert it to a fraction. All right. So tomorrow, next session, we're going to be talking about trend trading. Now, between now and tomorrow, see if you can identify any pairs. Trade them simulated, obviously, until you get the hang of what you're doing. But trade them simulated, see if you can find any pairs, take a screenshot of it, bring it to the session tomorrow, and we'll take a look at it. Tomorrow, though, we're going to talk about trend trading pairs and how we do it with the trend, something like gold versus silver. Okay? I'm not sure what you mean, Manuel. How to set up the TradeStation chart? Again, you need to watch yesterday's video. All that stuff was covered yesterday, so I don't want to go over it again today. Keep everybody here. All right. So, all right, that is it for today, everybody. You mentioned that nighttime risk is something to hedge if you are worried, but are there good times to enter trades outside market hours for exchanges? I didn't say nighttime risk is too high or anything. I hold trades overnight all the time. I don't hedge them. But I mean, they're pairs, so they're market neutral. The pair should play out. For example, S&P Dow pair I'm in right now, I'm going to be holding this overnight. That was talking about, I think you're confusing something that somebody said in Slack, which that's not how I trade. No, Manuel, I do not. European pairs, I do not. I'm sure you can trade the bond pairs, European bond pairs, and you can trade the DAX versus, drawing a blank now. So I'll never trade the market. I don't remember. The other European stock market. But you go look at the correlations, see how well they're correlated before you do that. Yeah, Euro Stocks versus DAX. So, all right, everybody, that is it for today. So I hope you guys enjoyed it. I will see you tomorrow, bright and early in the trading room, and tomorrow evening